Welcome back. I just wanted to say a few words before we go on. As many of you know, for the last 5 years, the Macrofinance Society has been bringing PhD students to its semi-annual workshops, and originally under the support of the Sloan Foundation, and more recently with the support of the Becker-Friedman Institute, Macrofinance Research Program, and really with the support of Lars Hansen, who is here and who had this great idea as we are adapting to the digital format, and since BFI is hosting this meeting, to have a virtual poster session as a way to include the PhD students in the proceedings of the workshop. So first of all, many thanks to Lars for his help and support to Macrofinance Society in general and this meeting in particular. And Lars will preside over this special event. So thank you, Lars, and the floor is yours now.
Okay, very good. Thank you very much for this. This seems like it's been quite a stimulating conference so far. I'm very pleased that we have 4 looks like promising presentations to hear from. Now, these presentations are going to be very short. We'll give 8-minute presentations. We'll allow for another 7 minutes of discussion. It would be great if people that hear these presentations and don't get a chance to comment, maybe you can send emails to the presenters to give them more feedback as well, as given the short time constraints here. It's hard to imitate a real poster session here with all the informal exchanges that could take place. But anyway, I'm very pleased that we're doing this, and I'm happy to host this event. So let me start off with Rashad Ahmed talking about global flight to safety shocks.
Thanks, Professor Hansen. Can I share my screen? Let me see. Is everything okay? Everybody see my screen? Perfect. So first off, thanks so much for this opportunity. My name is Rashad Ahmed. I'm a PhD candidate at University of Southern California, and I wanted to talk a bit about my project titled Global Flight to Safety Shocks. Now, what am I referring to when I'm referring to this? Well, it's a financial market phenomena typically triggered by unusual, unexpected, unique tail type events. And these are characterized by this systematic pattern where we see a sharp drop across risky asset prices, a strong rotation into safe assets, typically amid rising uncertainty and volatility. And a very recent example that's in the back of all of our minds is March 2020, COVID-19. But despite the uniqueness of the pandemic crisis, this sort of systematic flight to safety has been a reoccurring phenomena over the past several years. And that sort of brings us to this paper. Despite the recent attention on flight to safety, we don't really have there's no consensus on how to really measure appropriately these sorts of shocks. So this paper tries to present a pretty standard, simple way to capture these and then investigate their properties and their implications. So what I show in the paper is that they do in fact map back to disruptive tail type events. They tend to reflect both risk sentiment and physical risk, global demand. And importantly, they have macro implications. So much of the recent literature that's studying these flight to safety episodes or risk off episodes focus on the behavior of asset prices or capital flows. I'm going to show you that there's also a significant link between these flights to safety and subsequent economic activity, particularly across a panel of emerging markets. I find that these flight to safety shocks can explain significantly contemporaneous, but also future variations in world commodity prices and US interest rates. Moreover, they have a significant impact on emerging market industrial production over an 18-month period. But these effects are not uniform across countries. So the VAR that I estimate that I'll talk about later shows that there's a lot of heterogeneity, and I link this heterogeneity to different financial factors. So I find that domestic financial conditions moderate the transmission of flight to safety to macro fluctuations. Whether a country has significant presence within US ETFs is an interesting channel as well. And then finally, the countries that tend to lean against the wind and expend reserves in response to a flight to safety or a risk off down the line, they seem to also have experience more benign or shallower economic contractions. So the paper's really separated into two parts. The first part is really about getting to these flight to safety shocks. How do I build them? Well, first I have to start with a set of candidate global benchmark assets, and here there's a little bit of guidance. And there's flexibility, but just to keep things very straightforward and not controversial, I picked 5 candidate assets, and that's the VIX, high yield US credit spreads, US equity market returns, FX carry, which I proxy with the Australian dollar Japanese yen exchange rate, and 10-year US Treasury yields. Now, in the first stage, I first scale each asset's daily returns using their ex-ante or forecasted conditional volatility. And then using these scaled returns or shocks, I'm going to rotate and aggregate these separate fluctuations into a measure such that positive values indicate risk off or flight to safety, and negative values are going to indicate risk on or risk taking. Now, so it's very straightforward, robust, including different measures, different additional assets, European, German bonds if we want, etc. The second stage, we're going to impose what I'm calling the flight to safety condition. Again, very intuitive. I really want to, I want to really emphasize these flight to safety episodes. That's what I want to study. So I'm going to look at observations or periods where we see a concurrent rise in the VIX, widening high yield credit spreads, falling equities, unwinding carry trades, and safe asset yield compression. So this is going to be the directional identification that I'm imposing to get to my flight to safety shocks. We can also extend this and not just require a directional restriction, but a size restriction if we want to really emphasize tail type episodes. So a very simple interpretation of this index is that large values reflect joint tail realizations and asset returns that are consistent with the behavior of flight to safety. If we take the daily index and we aggregate it to the monthly index, we get something like this, just to give you a flavor of what we're working with. Positive values indicate risk off or flight to safety. You see a large jump around the financial crisis in 2008, 2009. You see another large jump in 2015, 2016, around the time when commodities were collapsing and there was concern over global growth and the Fed wanted to lift rates off the ELB. So we go about really studying the properties of this of flights to safety. But the one aspect I wanted to emphasize today and share with all of you is the implications it has for the macroeconomy. So what I do is I build a multi-country structural VAR for 34 emerging markets, and I feed these flight to safety shocks in as an external instrument. I shock it to simulate emerging market outcomes. And what do we see is almost immediately upon impact, there's a wide sharpening in sovereign risk across countries. There's a little bit of overshooting. We see currency depreciation, and we see significant depletion of international reserves. And subsequently, we also see a significant contraction in economic activity. Now, the red dashed line is the same model. It's just a robustness check. We're controlling for contemporaneous fluctuations in the VIX. So what that tells us is that these effects, whatever this measure of flight to safety is measuring, there's additional distinct information that just simple fluctuations in the VIX or financial conditions aren't able to capture. And then, the model I have admits to a lot of heterogeneity. So I study why some countries are more sensitive to these financial shocks than others. But I wanted to just focus on one of the interesting channels today, and that's looking at differences between countries which are exposed via presence within US exchange traded funds versus those that are not. Obviously, the ones that are more likely to be more financially developed and financially open. But when we stratify the sample into these two subgroups of countries, we see that there's a very, very large difference in the way their business cycles respond. So the countries that do have presence within US ETFs, with a lag, their industrial production, their economic activity contracts roughly a magnitude 4 times larger than those countries that do not. So that's just an interesting channel. It may be linked to volatile capital flows associated with flights to safety. But just to high level, some of the key takeaways I'd like to discuss more. One is these flight to safety shocks, they're not necessarily the same as more general financial fluctuations that we typically study, like VIX fluctuations. Flight to safety shocks, there's a lot of evidence suggesting that they embedded in them are both changes in risk premia and also global demand. So that would be supportive of a class of macro models where second moment and first moment shocks are not considered independent. The heterogeneity and its link to different financial factors is, there's a large literature also discussing that. So I'm finding empirical evidence supporting that. And then importantly, I didn't really touch on it here too deeply, but I'm finding some interesting evidence suggesting a role for international reserves as a buffering policy tool to lean against the wind during these risk-off episodes. That's consistent with some recent work around similar topics. And that's it. And, like Professor Hansen mentioned, my email address, if we can't get to more questions and comments in the limited amount of time, please contact me.
Thank you very much. Let me first ask a question. It would seem to me like these phenomena you're talking about, flight to safety, would not only be shocks, but they would also affect the mechanism by which shocks are transmitted to the macroeconomy. And I couldn't tell if your VR evidence was kind of holding fixed the transmission mechanisms and just focusing on the shocks, or is there state dependence in the transmission mechanism itself? And then particularly, one could imagine negative and positive shocks might have different implications and the like. So I guess more in the way of a question, what type of nonlinearities are in the macroeconomy here, and what type of state dependencies are you allowing for?
Thanks, Lars. So I have not. So there's a number of different state dependencies and nonlinearities that might be in play. I haven't gotten around to investigating all of them. I did have in a previous version of this looking at asymmetries versus risk on versus risk off, which I think is very important. And I was finding a significant difference in the response of macro fluctuations following a risk off, much larger than risk on. But I'm still working on fleshing that out for this version of the paper. Some of the other interesting state dependencies that I'm finding, interesting patterns in, I think one of the most interesting is the accumulation of international reserves, or having some sort of buffering or balance sheet effect that central banks may have some sort of role that they can play. That's linked to, so the specific evidence that I'm finding is that these countries that do more aggressively deplete or expend their international reserves following one of these shocks, down the line, it seems to be associated with a more shallow economic impact. Now, obviously, I'm not saying that this is causal, because there could be many different other factors confounding this relationship, but I think we also cannot ignore it. And this one particular pattern is getting a little bit more attention. There's been a recent paper discussing theoretically the role of sort of countercyclical or leaning against the wind reserves policy to battle these risk-off episodes. So without going into many different factors, I think I'll just leave it there and focus on that one that I think is particularly interesting. Maybe the ETF channel too, because that's something that's relatively new. Maybe we haven't investigated much, but these are things I'm still continuing to sort of dig into a little bit deeper.
Perhaps we have time for one question. It looks like Alp Simsik has a question to ask.
Hi. So I really like this paper. I think it's really great, the empirical evidence, very compelling. I just have a comment on the mechanism that you say that this points to models where the second and first moment shocks are correlated. Actually, if you think of, if you introduce nominal rigidities, like in Keynesian models, the second moment shocks are actually naturally also aggregate demand shocks. So you don't really need a separate shock. So these shocks that raise the risk premium will lower the interest rate. And in Keynesian models, it's the central bank that needs to cut the interest rates. And in practice, it won't be able to do it in real time. So you will naturally see a reduction in aggregate demand. And especially when the central bank is constrained, like because of zero lower bound, or maybe because stabilizing exchange rates. But even without that, these shocks are actually very naturally aggregate demand shocks. That's just a comment on the mechanism, but the empirical evidence is great. Thank you.
No, thanks so much. I'll definitely take that into consideration. I think when I was really thinking about Bloom type models where you have this exogenous uncertainty shock. So thanks for bringing that to my attention.
Okay, I think the time is about up. Thank you for the very nice talk and interesting discussions.
My pleasure.
For our next speaker, we have Shohini Kundu, and she'll be talking about banking networks. And let's see, I'm not going to have the full title here. She's going to talk about banking networks, and I'll let her fill out the rest of the title.
Okay. Can everyone hear me okay?
Yes.
Okay. I'm just going to start a timer to make sure I stay within the limits. Okay. So first, I'd like to thank the organizers for giving us the opportunity to present this work today. My name is Shohini Kundu, and this is joint work with Nishant, Vats, a colleague at Chicago booth. The title of this presentation is Banking Networks and Economic Growth, from Idiosyncratic Shocks to Aggregate Fluctuations. So the main question we're after in this paper is, how do non-bank capital shocks transmit through banking linkages? Addressing this question is important to study how different types of shocks have varying macroeconomic consequences. So in theory, when banks are the primary source of aggregate fluctuations, banking integration can result in the synchronization of business cycles. But when non-banking capital shocks are the primary source of aggregate fluctuations, theory suggests that business cycles are decoupled and experience negative co-movement of business cycles. And while there's been a plethora of empirical work that studied the transmission of bank capital shocks through banking networks, the study of non-bank capital shocks has been pretty bare. In this paper, we present a mechanism of how banks can act as aggregators of non-bank capital shocks. So what's the main difference between non-bank capital shocks and bank capital shocks? Bank capital shocks directly affect the aggregate amount of loanable funds, while non-bank capital shocks affect the relative lending share across geographies while keeping the total stock fixed. And hopefully this will be a little more clear in a few slides. So first, consider the following microcosm of our mechanism. There are only two states in an economy, Virginia and Maryland. And Virginia's chief exports are soybeans, and Maryland's chief exports are airplanes. So prior to banking deregulation, these states were connected through an export-import channel. The blue dots signify banks in Virginia, and the yellow dots signify banks in Maryland. So Virginian banks can only operate in the state of Virginia, and Maryland banks can only operate in the state of Maryland. And the only way these two states are connected is through trade. Now with deregulation, in addition to a trade channel, there's also a banking channel. So Virginian banks can now branch out to Maryland, and Maryland banks can branch out to Virginia. So you can see there are blue dots in Maryland and there are yellow dots in Virginia. And what this means is that in a given year, if a Virginia factory experiences a bad shock, say a fire or something, and they can't harvest as many soybeans, banks will divert their capital out of Virginia and plow it into Maryland. An increased investment in Maryland will lead to greater economic growth in this state. So what do we do in this paper? First, we focus on non-bank capital shocks, which we call idiosyncratic shocks. And these are defined in line with the methodology of Gebek's 2011. Second, we develop a simple statistical framework underlying our empirical specification, where the transmission of non-bank capital shocks to domestic economic growth depends on banking linkages. Third, we provide evidence that after banking integration occurs, banks' choice set expands. So rather than being limited to just investing in a single state, banks can allocate capital between states. This is what connects shocks in one state to economic growth in another state. So if there are shocks to state I, banks will divert the loan supply to state J, and an increase in the loan supply in state J will foster greater economic growth in state J. Lastly, we connect our findings to the discussion on the Great Moderation, and we propose an alternative explanation behind the decline in aggregate volatility that characterizes the 1980s and onwards. So theoretically, the effect of banking integration with idiosyncratic shocks on aggregate volatility is ambiguous. And this is because the diversification of banks in the presence of non-bank capital shocks can reduce the covariance of business cycle fluctuations, but it can increase the variance. So if the reduction in covariance dominates the increase in variance, aggregate volatility can decline. And this provides a mechanism to explain why the overall US economy didn't react to exogenous shocks during the Great Moderation as strongly as in previous periods. So in this figure, we show the relation between economic growth in state I and idiosyncratic shock in state J over time. And we plot the estimated betas from a 5-year forward rolling regression from 1978 through 1995. As you can see, beta monotonically declines from 1978 through 1991, decreasing from +1 in 1978 to -1 in 1991. This result suggests that states behaved as complements before the mid-80s and more like substitutes after the mid-80s. So in other words, good news for Illinois meant good news for Indiana in the late 1970s and early 1980s. And this changed mid-1980s when good news for Illinois translated as bad news for Indiana. In our baseline specification, we run a state pairwise regression of GDP growth in state I on the idiosyncratic shock in state J, a post-dummy which indicates whether the two states have integrated, and the interaction of the two along with a number of state and time fixed effects. So in column 1, we have no fixed effects. In column 2, we include year fixed effects. And in columns 3 through 6, we include a combination of region year fixed effects as well as state pair and state year fixed effects. And as you can see from the sign on the interaction term, the cross-border transmission of shocks changes post-banking integration. So this means that a negative shock in state J increases economic growth in state I. Specifically, a 1 standard deviation negative change in the sign of the shock increases economic growth by 0.05 percentage points. How does this happen exactly? So the change in the transmission of idiosyncratic shocks across states through banking networks occurs through changes in the loan supply. So using the methodology of Gebex and Koyen, we exploit a GIV design and find that a 1% change in the bank loan supply is associated with 0.05 to 0.26 percentage points increase in economic growth. This effect is more dominant in places where banking expansion occurred, and it's not an instantaneous effect. So it's not the case that banking expansion occurred the instant states decided to deregulate. This effect is especially dominant when the idiosyncratic shock exhibits characteristics associated with idiosyncratic shocks, like low spatial correlation, low temporal persistence, and is positive. And I'm happy to explain why these are consistent with our predictions during the discussion. So to conclude, our results suggest that the transmission of non-bank capital shocks results in the negative co-movement of business cycles. This work has policy implications. So in recent years, the European Union has proposed and implemented steps towards the creation of a European banking union and European capital markets union, part and parcel of a broader economic and monetary union. And these policies are intended to converge the economies of EU states and improve the resiliency of the economic and monetary union through a centralized shock absorption system. But our results suggest that a stronger banking union could lead to the divergence of economic growth between member states if there are non-bank capital shocks as they transmit through the economy. We don't claim to settle on any of these debates, but our results do provide another dimension for deliberation. Thank you.
Thank you very much. Let me just ask one thing. You mentioned that you have results related to how these dynamics play out in your next to last slide, which you didn't have time to talk about. Could you elaborate a little bit more about how that dynamics plays out over what time frame we're seeing these growth differences as I have these changes in the banking regulation?
Sure. So the effect doesn't take place instantaneously, and we find that the effect settles in after roughly 5 years. And we've done an additional analysis where we look at whether it actually is the case that out-of-state banking assets increase after deregulation is passed. And indeed, we have found evidence showing that there is a greater increase in out-of-state banking assets for early deregulators as compared to late deregulators, using a framework that's similar to what we see in the Atif Mian, Amr Sufi, and Emil Werner paper. But it takes roughly 5 years.
I see. Interesting. Do we have some more questions? Any more comments or questions for the audience? Do you, with a little bit of extra time, do you have any final last words or anything else you might want to say? It's not necessary. It's a very interesting project. So. Okay, well, now we'll go on to the next speaker. Thank you very much for this interesting presentation. The next talk will be by Xinyang Li, Bond Implied Risk Around Macroeconomic Announcements.
Yeah, thanks, Lars. Okay, can everyone hear me?
Yes.
Yeah, okay, great. Hello everyone, I'm Xinyang Li from Boston University. I'm so glad to be here to present my paper on the implied risk around macroeconomic announcement. But the first question is, why does bond risk even matter? The bonds, especially the treasury bonds, are often treated as safe assets. However, the safe assets are embedded with risk. And let us together look at this graph. Here I graph this stock tail risk in this blue dashed line represents and directly from this stock still index from CBOE. And the bond tail risk is what I derived in this paper by using a similar index construction, but applying with treasury bond futures and options data. And we see that in this year's, in the middle of March, the bond tail risk enlarged hugely, as we know that investors start panic and there's a lot of stress and discussion about safety and liquidity. So that we can still see that the safe assets are embedded with risk, and there is a disconnect between the tail risk in the bond and equity market, because in the same time period, the stock tail risk has already resumed to normal. So this triggered me to extend the time frame to look at the overall trend through 2000 to 2019 to look at the bond uncertainty and the tail risk embedded in the treasury market. And the method here is just very similar like to the index construction of the width and stillness, but I apply with the treasury bond options data. So I derive this treasury bond implied uncertainty and tail risk. Here I graph this bond tail risk for the maturity of the 10-year and 30-year here. And I document 3 important findings here. The first is that there is a negative correlation between the stock and the bond tail risk. And this is interesting because actually the stock and the bond uncertainty risk, the weight measure actually move together positively and strongly. The next thing is that the bond tail risk enlarged dramatically before the 2 financial crises here, and especially profound for the second one before the 2008. And during the same time, actually the stock tail risk only increased moderately. And I'd like to attribute it to that the fact that the 2008 financial crisis started and emerged from the subprime mortgage risk and the defaults, so that it's more related to the interest rate market rather than the equity market in the beginning. And people may argue that I first mentioned the negative correlation between the stock and the bond tail risk, and then they both enlarge before the crisis, because this both holds true. And the negative correlation holds in a general term in normal times. But before there's a lot of stress in the market, the correlation actually become positive. And we can still see this as this And this year, as an example, before the most serious months, the correlation is positive, but after things become much more normal and acceptable, the negative correlation revert. And the third feature is that the bond tail risk become much more smaller in the recent years. And the impact of the zero lower bound and the forward guidance, there's really not much room for the interest rate to move, so that the tail risk become much more smaller in recent years. But we can still see that the bond risks are likely be affected by monetary policy. So the next thing I look at is that the bond uncertainty and the tail risk around the FOMC announcement. And here I find a very similar pattern, just like many authors in the equity market already found that the uncertainty risk in the bond market surged on the third and second day before the announcement, and it holds for another day and before suddenly dropping upon release to reflect this uncertainty resolution. And however, in the tail risk moment, I can see that the tail risk specifically responds to the FOMC announcement. And after talking about risk, it's natural to think about the following pre-FOMC announcement drift. And this all of the paper led by the Luke and Monk in this similar paper that documents that on the announcement date, but before 2 p.m., the announcement time, there is a lot of return already accumulated in the stock market. And here I use the daily data, but also look at the treasury bonds. And I found that this also holds true in the treasury market. By looking at the yield, I find that the treasury bond yields drop about 1 basis point on the day before announcement. And people try to explain this pre-FOMC announcement drift by 2 channels. One of them is uncertainty resolution. And here I want to extend the work in the equity market also to the treasury bond market. And by using these regressions. And here we can see that the uncertainty change predicts this bond yield change positively, also for the stock market positively. So in this way, if we see the bond yield actually decrease on average, this uncertainty change cannot extend to the market of the treasury bonds. And the second is if we look at this interaction term to denote this special pre-FOMC announcement, pre-FOMC uncertainty effect, we see that there is some offsetting here, and this is consistent with others' paper about the post-announcement effect of the bond yield, but they are not that significant for the pre-FOMC announcement effect, except for the 30-year bond yield. And if we summarize these 2 coefficients together to look at this overall uncertainty effect, we see that maybe for the 30 bond yield only, the uncertainty can help explain a little bit of the pre-FOMC announcements, this drift. But let me give you another 3 number. That's the uncertainty increase on average about 0.5%, 0.2%, and 0.3% for the stock, 10-year and 30-year respectively. So if we multiply this number by the coefficients, we see that uncertainty really helps very little about it. So that, and much of the drift is still located here, even for the stock. So that in this paper, I conclude that the uncertainty risk cannot explain the pre-FOMC announcement drift. And I also look at other macroeconomic announcements, about 25 of them, and I find that the release of unemployment rate reduces the bond uncertainty. And yes, that's basically the paper. Thank you.
Thank you. Just one quick question.
Mm-hmm.
You were documenting some, the impact of things like Fed announcements and or Fed announcement dates on volatility and the like. Is there, do you have a way to quantify what's driving the volatility per se, whether, you know, how much of it is given by Fed policy and how much is being driven by other kind of things having nothing to do with macro policy? Do you have any way to kind of parse out the type of volatility movements which you're looking at, or to attribute it to various primitive sources?
I'm not sure about it. I just documents there's uncertainty upsurge, and I found that during it is also true that for the treasury bond market, the liquidity at that time is low. Just as Luke and Mont find in the equity markets, the liquidity, the trading volume has been low before the announcement, and after that it has been much more frequently. And yeah, that's my opinion.
I see. So what do you see as the interesting next steps for this research? What do you plan on doing? Where do you plan on taking this?
Yeah, I think there's a lot of things can be done to extend this work. Besides the FMC announcement, I also document this negative correlation between the stock and the bond tail risk, and I think that's a very interesting question. Maybe I want to extend it to the flight to safety. And many authors are really very interested. I think it's a really good point to look at this. Also, there may be some trading strategies to look at the option portfolios, because maybe I can mimic this stillness, the tail risk in the stock and bond market. And since they are negative correlated, there could be some arbitrage in it. And that's about two strengths that I'm going to explore.
Interesting.
Yeah.
I'm just give the rest of the audience an opportunity to do any if you could do any hand raising if you have further questions, so it'd be great.
Hey.
Can I have a comment?
Uh-huh.
So I was wondering whether you had a chance to look at the FOMC cycle returns. Can you hear me?
Yeah, I can hear you.
Yeah, the analysis log and Ahmed visiting your Hansen work. It would be cool if the bond tail risk have some FOMC cycle effects. And also, you looked a lot at the pre-FOMC announcement. Another interesting phenomenon which was documented is high stock returns on the macro announcement days. And maybe there is some relationship between bond implied risks being higher when this abnormal macro announcement return, when we have abnormal macro announcement returns, it's sovereign bills and work. And another paper which you might find interesting is common shocks in stocks and bonds by Anna Cislak, which is new working paper. Maybe that could be useful to look at it as well.
Okay, and thank you for your suggestion. And I do look at the macroeconomic announcement, and just as many authors have already find that there is a small drift here, not that as big as the FMC announcement. And I find similar things in the bond market about the bond yield, but it's not that significant. And so I just decide to eliminate it. And also I think for the bond yield market, it's not that specific on the day. So I cannot attribute it to the announcement. And in this way, I didn't put it into my paper. Yeah. Thank you.
Are there other questions?
I think this is the way.
Hi.
Go ahead, Winston.
Okay, thanks. So I think it's quite an interesting topic. I'm wondering what kind of frequency sorry, I missed that part, is what frequency of your estimation of the tail risk? I'm asking
daily
because,
frequency.
Okay, daily frequency, okay, maybe. So I'm asking because I know there are some like econometric tools being developed using this high frequency. For example, Jia Li at Duke has some papers. It's like, using like a high frequency methodology to test and identify what really this micro announcement mean in the capital market. So how the dimensionality and whether it's focused on volatility or focused on jumps, I think maybe that's something you can dig into and strengthen the identification and make your storytelling much richer.
Yeah, thank you very much for this. Yeah.
Do you have other comments or questions?
So I'll chime in. So I just wanted to clarify, when you're computing the skewness for equity and bonds, so for both of them, you're using this option-based measure, right?
Right.
So then you think actually, so your picture was about the COVID episode, but it seems like outside of the COVID episode, that's what you would think during the period of stress, because when people sell off equity, they buy treasuries, right? So there is actually, they kind of supposed to be moving in opposite directions, kind of in an extreme way. And then, of course, the paper that we had before the session showed that during this period, it was actually the opposite, right? That people were selling off treasuries as well. So you actually think that this is the time where they would be positively correlated, right? So
Yeah.
I don't know if you can shed light on that or not.
Yeah, I'm always trying to explain it by maybe flight to safety and flight to liquidity. And just in this morning, the authors gave a very good point about it. And I'm trying to incorporate it and understand it and see if you can put it in my paper. Yeah, thank you.
Okay, very good. Any other comments or questions? Well, if not, thank you very much for a very interesting presentation. And let's move to our fourth speaker of this session, Oscar Soons. We'll be talking about the safety demand in a diverse monetary union and the effect of a common safe asset.
Yes. Can you see my slides?
Yes.
Okay, so thank you for also including me in the program. It's been a super interesting, I'm sorry. It's been a super interesting day so far. So, I'm sorry, they're announcing that the building is closing. It's the evening. I'm sorry about that. All right, sorry about that. So my paper is on the demand for safety in a diverse monetary union, with a subtitle "Why Introduce a Common Safe Asset." So this is really the general question that the paper is about. Why does a monetary union need a common safe asset? So I'm particularly interested in the euro area, which is a monetary union, of course, that until very recent did not have any common debt issuance. And now after the COVID crisis, there is some debt being issued, but it's also seen still as a temporary solution. So I want to think more about why all member states, so core and periphery countries, would benefit from a permanent common safe asset. So I do this using a two-country model of a monetary union, in which then I will study household investment decisions in a context of a safety demand. So households will choose to either invest in safe asset or in productive investments, so take risk. And then I show that introducing a common safe asset will affect this productive investment decision. And it may increase productive investment. So this is a theory paper. So just going to give you a flavor of the model. There's three key assumptions. So it's a model, it's a simple model with households and a government, and the households have preferences that include a minimum consumption need. So that's a modification of Stone-Geary preferences, and it results in a very clear inelastic demand for safety. So households, they have this non-negotiable subsistence need, and this obtaining this is a precondition for any further actions, for taking any risk. Then second, governments maximize household utility and they choose public good provision, but their public spending also lowers safe asset demand. So how I think about that is that if you have a household and one person works as an entrepreneur and the other person works to produce the government's public goods, then if there's a crisis, the entrepreneurial income might become very risky, but the safe wage income from the government worker is very safe. So the government doesn't only provide these public goods, but it also supplies safety in the process. And then third, households have this clear safe asset demand. They obtain safety from public debt and from public spending, but they can also obtain safety from the private sector. So the private sector has a technology that has a minimum payment in all states, but this minimum payment has decreasing returns to scale. So I think about this as the real estate market, for example. And the private sector's alternative is more a productive technology that has a higher expected return. So in this setting, a social planner would optimally maximize productive investment, subject to using the minimum amount of resources to obtain safety in all states. So to summarize this portfolio choice, here in the figure, the orange line is the inelastic safety demand. And for any price, there's the same amount, the same quantity. And then part of the safety demand is obtained by public safety and part by private safety technologies. And if public safety would increase, then this lowers the reliance of households on the private safety technology. And so I say that public safety is then scarce if this substitution will support productive investment. So if households rely less on the private sector for safety because there's more public safety, then if that leaves more resources for productive investment, then public safety is scarce and productive investment benefits from more public safety provision. And this concept of public safety scarcity, I will use as a rationale for a common safe asset. So in a monetary union, in a diverse monetary union, some governments produce more public safety than others. And because there's no exchange rate risks or it's one capital market, households in countries with little public safety will invest in foreign public safety in equilibrium. But this means that these capital flows, they imply safety spillovers, but the cost of producing public safety is still a domestic matter. So if here France would issue more bonds to spend more to provide public safety, but the German households will buy some of these bonds, then the safety produced for the French households is smaller. So the marginal safety benefit for the French government is smaller than the marginal safety benefit for the whole monetary union. So actually, if each government will choose an optimal public safety provision, individually optimal, then from a union perspective, there's a public safety scarcity. So this then would be a rationale to have a common public safety provision funded by a common safe asset. So then in the paper, in the second part, I introduce a central institution that will issue common debt, and then production will benefit in all member states, or can benefit in all member states when total public safety increases. But then I show in the paper that the design of this common safe asset still matter. So without getting into too much detail, I consider what is done with the revenue. So contrast what I call autonomous or common public good provision. And the intuition is that if the revenues from this common safe asset are just handed back to each government, then each government, so this autonomous public good provision, then each government will lower its own public safety provision additionally. So then the net effect will be much smaller compared to when the common institution will provide public goods. Second, I think about how it will be repaid. Is there risk sharing or not? And are there new common tax revenues? And for example, this will matter because without any of these, the volume of a safe asset might be very limited depending on the fiscal capacity of the weakest country in the union. So with this paper, I aim to contribute to the Eurobond literature, which I think so far has focused a lot on risk sharing for good reasons. I think this is a very important, definitely of first order importance. But I think that the demand for safety is also first order importance. So that's what I really want to focus on instead of risk sharing, especially today. So this week in Bloomberg, there was an article with this title, because the European Union had its first social bonds issuance that drew a record demand. So there's this big demand for safety, especially now that people have realized that public safety is very important in very bad states. So just to conclude, so I focus on the demand for safety in a monetary union, and this then provides a rationale for a common safe asset. And then in my framework, I can consider the effect of certain design choices of this asset. And then the takeaway would be that I show that all member states can benefit from such a common safe asset, also outside of crisis times. So that was it, and I'm very happy to get any questions now, or otherwise you can always send me an email.
Thank you. I was wondering whether you could elaborate a little bit more on the implementation, like we were talking about challenges in terms of how things get funded and what happens to revenues and the like. So this is obviously something which you've thought a lot about. Is there anything more that you can tell us along those dimensions or about policy implementation?
Yeah, so there's a choice to make whether this asset will have any risk sharing or any mutualization. So if there's any state of the world where then part of the member states will be liable for the share that other members would have to pay. And in my model, actually, having new common tax revenues would be a better solution than having mutualization. I mean, for a simple reason, because if you do mutualization, then in the country that is always liable for the other country's share in a very bad state, then the expected taxation would increase in that state, in that country, which then affects the safe asset demand in that country. Well, if you introduce new common tax revenues, then if these can be designed in such a way that they don't affect the tax base of each country in a low state. So that's what I mean with new. So they're orthogonal to each country's tax base, and that then would actually be a superior outcome.
Yeah.
And also interesting in my model is that mutualization is also not necessary. So even without mutualization and no common tax revenues, if there is common public good provision, then this could still lead to an increase in productive investment in the whole union.
Yeah, so this is like more also a continued endorsement to the fact that we need to be thinking about monetary and fiscal issues simultaneously and not the role of monetary policy in isolation.
Exactly, yes.
Yeah. Are there other questions or comments?
So what are your thoughts about, you mentioned the two different ways of setting up the risk sharing for the bonds. Which would you imagine were more difficult to push through politically? Like which would have a bigger, which would have faced more public resentment? Would it be the common tax? Like I could see that some people don't want to pay tax to Europe, but I could also see the Germans being very much against having to foot the bill in the worst state of the world. So what are your thoughts on that?
Yeah, I think that I mean any mutualization in that sense, I think is politically unfeasible. I mean that's also why we haven't had a common safe asset yet, because I mean they've been talking about it for years. So I think the new common tax revenues, in my opinion, is the best way forward. And then I think it's an important question how to frame it. So I think also it's important that it's who you target. So I think particularly you could target, which also is a plan, let's say the very big corporations that work across the whole union, that also each member state individually might not be able to tax them, but as a union as a whole, you may be able to. And then German citizens will also not directly be affected.
Right, yeah, that would be a good way of spinning it, yeah.
Are there other comments or questions, suggestions? Okay, well, if not, I guess I would like to thank all the 4 speakers, interesting projects. I look forward to seeing how these lines of research mature as you take these ideas further and develop them further. Thank you very much for your participation, and I think we're all looking forward to an exciting day tomorrow.
Thank you, everybody. Thanks for the participants and presenters. So we'll start tomorrow with a keynote by Daryl Duffy, and then we'll have 2 more. See you tomorrow. Thank you.
Yeah, thank you everybody for coming.
Thank you, Mike.